Yogesh Bhatt is with me. He's Senior Equity Fund Manager with ICICI Prudential Asset Management Company. Yogesh, thanks very much for your time. Good to have you here. Just a broad sense on the earnings that we've gotten so far, both in terms of what was expected and against what was expected, because expectations are already muted, so maybe in some cases there is a beat, so we could call it in line. But also earnings in the context of what earnings are required to drive the market forward. So on both parameters, how would you assess earnings so far?
So far, if you break up whatever the earnings have come so far, the expectations are, as you rightly pointed out, it's already muted. So the street is expecting anywhere between kind of a 3 to 4% kind of earnings growth on the Sensex and Nifty. So you have a couple of big IT results which are already out. The banking side, we have seen mixed bag with smaller and mid-sized banks are still facing some issues on the NPL front. On pharma side, so far no big results have come so far except a couple of mid-cap, mid-tier companies. And specifically, I think the biggest point or biggest area where people would be looking is how the capital goods or the industrials are faring out. And obviously metals, as you know, are not expected to be doing so well. So if I put together net, I think 2 to 3% kind of a growth this year, ex-energy, should be fine. I think the broader question needs to be asked is what is expected on the full year basis and on FY17 basis, because market normally discounts 1 year forward. And on that, I am still expecting some toning down has to happen from the street side, because street is still between 13 and 14% kind of earnings for FY16 and around 20% kind of in FY17. And I would be very happy if earnings comes down to around say 9 to 10% for this year and say around 13 to 15% range for the FY17 or FY16. So I think that is the broader mood questions to be asked rather than just concentrating on this quarter. This quarter.
So you're saying 16 earnings should finally settle down between, it's high single digits, right?
Yeah, that's what I'm trying to say.
And then what does that mean for 17 earnings, which everybody would start looking at the beginning of fourth quarter?
Yeah, so there I think the expectations right now, which are sitting at around, as I mentioned, 20 to 22%, should come down between 13 and 15%, which should be a realistic target. Because if I see from here on, I think the base also is coming to our favor and the macro parameters are falling in place, be it inflation, be it interest rates, or for that matter, the kind of even top line growth, what we have seen. So net, I think 13-15% kind of earnings growth for FY17 should be doable, and on that basis, it seems to be reasonably fine.
Financial 17 would also have the pay commission impact, etc., right?
Yeah, obviously. So, and hence you can have some of the discretionary names, maybe faring well. Specifically in the auto side, we can see some of the momentum, because last time we have seen in the 6th pay commission, there were some four-wheeler companies in the Indian space have done remarkably well. And so primarily what happens is your contribution from the government employees to your total sales goes up dramatically in that period. At the same time, if the other asset classes are not making any sense, I think people will shift towards the consumer discretionary side a little bit on a more side. So yes, 7th pay commission also is expected, and of course the range is between street is anywhere between 20 and 25%. I think it should settle somewhere in between. I'm not too sure, but if that is the number of the pay commission hike, I think that would bode well for the consumer discretionary.
20-25 seems a little high, doesn't it, Yogesh?
That is what the street is right now expecting.
I heard people talking about 10-15%.
Let's see, because the room available to government at that point in time, where the crude would be, or how your fiscal deficit or the current account deficit fares at that point in time, will also play a material role at that time.
This entire point about no inflation, actually disinflation, how should one, I was listening to the HUL numbers and the management commentary after that. They said, well, it's all volume, 6.5, no pricing growth. Pricing is the problem, but for markets, what does it really mean if we are in this process of disinflation for a couple of years? what would it really mean? Where would growth come from?
So that is where the basic question comes, is that the top line growth of the market, or for that matter some of the select sectors, will be kind of a washed out, and this is primarily because of the fact that though you have a pricing power, inflation is not helping you to generate or add to that pricing power and create a healthy top line in value terms. And then now you're depending on totally on the volume growth. So take an example of staples, for example. We have seen in the inflationary period of the last 5-6 years, the top line growth was, nominal growth was around 15 to 17%, and there was a 6-7% kind of a price element and close to around 6-7% kind of a volume element. And put together, you are posting that healthy top line of 15-17% on the nominal terms. I think going forward, yes, what we have seen in the results so far also, and which is expected in the next 4 quarters as well, is that you're totally dependent on the volume growth. Your pricing is not going to help you, because there are two reasons for this. One is commodity inflation, which has come down dramatically, is actually helping the unorganized sector in a big time. And in that environment, if the branded guys or the higher guys increase the prices, I think that will result into their market share loss, and that they will not like to do in any point in time. The second impact which is happening is on the EBITDA level also. Whatever the gross margin expansion which is happening, I think they are investing into the ad spends and something of that sort, and that is actually going to help the profit, put some pressure as far as the EBITDA margin is also concerned. The combination of these two, you will find that majority of the companies will not be able to pass on the kind of a pricing which we normally expect.
You know, I don't know if you have the number, but what percentage of the earnings growth, say over the last 10 years, for say Nifty or Sensex companies, would be led by just pricing? And how much would be volume?
Of course, it will differ upon segment to segment and the sector to sector. But if I say that if you just correlate, because there are some sectors which are directly connected to the inflation, like for example, even banking also, or for that matter staples also, for that matter some of the consumer kind of companies. So there, my estimate would be anywhere between 5 to 6% would be an inflation-led growth, and maybe 7-8% kind of a volume growth. So net, whatever growth which we have seen over 14 to 15%, I think you can split it between 50-50, half to volume and price.
No, so but at an aggregate level, market level, say Nifty 50 level, but because these are very clear, banking, consumer staples, I mean these are clear-cut examples, right?
But there also, if you see the composition of Nifty itself, you have a 30% banking, you have 15% FMCG, you have close to around 8% pharma. So these are the combinations, right? Auto is around close to 7%. So net, if I see, if you do that broad breakup also, will come down to around 45-50%.
So actually, then earnings growth, I mean, again, this is very rough talk, in a way, loose talk, but earnings growth should, top line growth should half basically, right? That's what you're saying.
That's what I'm saying, is that the expectations are running a little bit higher, and your top line growth is expected to be slightly muted, at least in the next 3-4 quarters, and that's where the bottom line also is getting impacted or has to be toned down to a large extent.
Has this realignment of earnings essentially happened already? In which sectors do you think there is significant amount of mispricing still there? And which sectors have kind of priced this new reality in?
I think if I see on a broader level, there are some segment which has been completely given up kind of a hopes. So specifically in the banking side also, on that also on the PSU banking side, people have kind of that is where your reflection is in the price to book multiple which all these banks are quoting at. There are private banks which are still a couple of banks which are still at a slightly premium, and there could be a possibility of some disappointment. And we have seen a couple of results in the last 1 week. Staples, obviously, I'm reasonably confident that people have not toned down their expectations, and their earnings has to be slightly lower. And the multiples are definitely still running much higher. So you have a segment already quoting at a 50% premium to Sensex earnings. So that is where the kind of a disappointment can come. The other segment, as I mentioned, is that metals and the oil and gas kind of a space. I think there also people people have aligned to a large extent, and they are not expecting big disappointment. And lastly, obviously, the pharma and the IT pack, where
autos as well, sure.
Pharma and IT as a complete pack, we have seen some adjustment which has been done on the large cap IT pharma IT names. And pharma is still quoting, I think it's a mixed bag there. There are companies which are quoting at a high multiple of 18 to 22 multiples, and expected earnings growth is slightly higher. There could be some disappointment there also. But net, if I see, these are the broad segmental differences as far as the expectations and the actuals.
Does this mean that one should look at, so then if this is the case, and if you're reasonably sure that if you make the case that we'll see disinflation and earnings growth coming under pressure because of that, and as that happens, at the same time competition is going up, you have to spend more on advertising, and it's a big factor. What does it mean for what becomes investable in that sense? I mean, as a large mutual fund, of course, you also, there is a degree of measuring your performance on a relative basis, right? But for our viewers, for example, or for people who are after absolute returns, what does it really mean? Where should one look at opportunities for? I'm asking you for a broad mental framework.
Yeah. See, if you see the broad, say, numbers so far, so if I see a 1 year return of Nifty, for example, is around 6%. You have FMCG sector has given you a 8.5% return. You have mid-caps as a space has given you a 20% return, 1 year basis. Banking has given you close to around 11-12% return on a 1 year basis. So if you see this component, I think 6% kind of a Nifty growth for the last 1 year is actually getting, giving you some kind of a nervousness, because otherwise the rally which started from August 2013, we have seen a height almost of 9100 Nifty, which has come down to 7500. So valuations were running a little bit higher. That got corrected. In the meantime, obviously the reasons are not only India-centric, but global reasons also played an important role in the last correction. But if I see from a broader point of view, I think medium term looks a little bit of a challenge. But if I take a 3 to 5 years view, I think as I mentioned, the economic parameters are so much favorable, and country as a whole, India is emerging out as a strong contender for a growth. Then if I see the allocations from the FIIs also, which we have seen the least outflows, like $2.6 billion quarter outflow last quarter we have seen, as compared to close to around $50-55 billion outflow into entire emerging market Asia. So that is showing you a strength which actually helps India bottom-up story. So I'm saying that yes, you have some near-term challenges in terms of earnings, how it is going to catch up. But if I take a 3 to 5 year view, I think equity as an asset class should do well, and as well at the same time the debt market also is quite attractive. The transmission is not happened to the extent what we want, and the kind of a rate cut what we have seen from the RBI is still to be reflected in the debt market returns.
So you said near term, you said medium term. So what? I mean, we are in 2015, right? October. Is it possible in the next 1 year also returns are very poor?
I think I would be not saying that very negative returns, but yes, you can have your own challenges as far as equity is concerned. But
possible that we end up with another 5-6%.
Maybe.
Right.
Yeah.
What about from now till October 2018?
I think there I'm reasonably quite bullish, because see the margins, for example, in India, on the India BSE 500 companies, we are sitting at almost around 15-16 year low.
Okay.
A capex cycle, as you know, we are at the almost 96-98 levels if I compare with the inflation. At the same time, interest rates, as we all know, are going to benefit the economy as a whole. The thanks to the commodity softness, and India being the largest importer of some of the high commodities, the current account deficits and the government fiscal is definitely in order. So all this put together, I am reasonably bullish that the story will pan out by 17-18 over a period of time. And in the meantime, yes, there are some reforms, there are some expectations from the market as far as GST is concerned, as far as some of the land and labor reforms are concerned. Those things obviously also play an important role. But I'm not too worried about those macro things not going to fall in place in a say 3 years period.
Yeah. Okay, for absolute return investors, right? Where should they focus on, and if they have a 2 year plus type of time horizon?
I think if you sectorally, if you divide, there are definitely some pockets where it is an expensive. So FMCG, for example, is expensive right now. There are even some of the banking side also seems to be slightly on the higher side. But if I see, say, sectors like industrials, for example, where there was almost no hope for the last 3-4 years, which has started, improving. So, for example, sectors like roads, or for example, sectors like infrastructure, or those are the sectors where the most of the actions are happening right now, and that's where the space where it is becoming interesting for a say 3 to 5 year horizon. At the same time, there are some sectors which are facing right now the challenges, like for example, telecom right now, which is facing its own challenges. As compared to when you see the expected returns there, the earnings are not expected to be dramatically high. The ROEs are suppressed. So I think I would try to look at sectors where ROEs has seen a depressed kind of a numbers over the last 3-4 years, and which is expected to improve, say, in the next 3-4 years.
And no, so you think telecom falls in that category, fits the bill?
Yes.
Okay. No, because I was actually going to ask you, I'll come to telecom in a bit. Which are the other areas that you identified?
So industrial, capital goods, infrastructure, I think those are the sectors also will find strong momentum in 3 years time.
But, there also stocks have multiplied manifold in some cases. And valuations relative to the earnings or expected earnings over a reasonable time frame, are they really cheap?
See, there are two things which is happening. One is obviously we have seen a kind of a 3 to 5x kind of a price jump from the bottom, actually, if you see, of August 2013. But I think that would be a wrong way to judge the companies. So the way we look into it is, for example, a company, any company if you take, if your order book position is, going to multiply, much higher than your expectation, then you are talking of a clear-cut visibility on the revenue side. And that if your revenue is quite visible, it will flow into your margins as well. And obviously the most important in the entire space, and the caution which I would like to put here, is how your balance sheet is, the situation of the balance sheet. Is it repairable? There are companies in the sector where the balance sheets are not repairable at all. And even if you put any extra amount of equity, it's not going to help you to come out from that particular mess. So I think one has to be very, very cautious about the sector and not paint everything with the same brush. I think you have to be very, very selective and try to do a kind of a bottom-up analysis, and then only try to invest.
If we take L&T as an example, just as an example, and see the reported order intake in the quarter so far, it falls way short of the required order intake to meet the 15% growth guidance, right? Nowhere near. And that's the largest company, the most well diversified, has got a leg in each of the infrastructure piece, so as to speak. So, except roads, where there is tendering, etc., which has been happening for a while now, it's not new. Where exactly is this showing up?
So I would say that you have to see the overall category where the company is, and definitely there are specific pockets which is doing well. There are specific pockets which is challenging even today. But at the same time, if you add back the earnings, I think, if you see the past also, there is always a possibility of your surpassing this number of order book when the cycle turns. And you start with 10-15%, but eventually you end up much higher number than those. That's what we have seen in the last cycle. I think that kind of a similar things can happen, and that's where the market is right now pricing is that though the near-term challenges are there, and there could be a real, definitely some problem as far as the growth in the short term. But I think if you take a 3 to 5 year view, I think there is a possibility of surpassing those actual growth numbers which people are, and that is actually has happened in some of the mid caps. If you see the kind of order book jump which they have seen in the last 3 months, I think it is far higher than anybody's estimates so far.
Okay, areas where there could be pressure going forward. Are consumer staples, clear category?
Absolutely.
Some private banks you mentioned?
Yeah, because you have to be cautious there. The valuations are running too high. At the same time, you have to be cautious on some of the banks where still the problems have not appeared. I'm not saying that there are possibility of any accidents, but I'm saying that yes, we have seen a couple of results, and you have to be slightly worried about that space as well. And obviously, where the other side of the story is where people have built in much larger expectations on the earnings, and they are just following the quality curve. I think those are the spaces where you should be slightly worried. So, for example, in some of the large cap pharma names also, the valuations are running definitely much higher at 22 to 24 times. I think there should be also, if the expectations are not met, can see some sideways movement or a flat earnings or flat returns as far as 1 year is concerned.
So IT and pharma, how do you look at both these? IT stocks are now trading at, just to take an example, TCS, you compare that to where Sun is trading, far lower multiple. Cash generation is very strong, ROEs are very strong, comparable. I mean, actually, IT would be higher in that sense, both the company and the sector per se. I'm just looking at IT versus pharma. How do you look at both these spaces?
There also, if you divide, there are even some large cap companies which are quoting at 12, 13 multiples now with the recent corrections which we have seen in the market, because there also the expectations were running high, and specifically because of the currency adjustment, many of the companies have faced challenges in the recent quarters.
Yeah.
But at the same time, if I see overall view, I think a lot will depend upon how the US is going to fare, and the way the interest rates jump has been delayed there, and the kind of underlying economy is not going to be becoming very strong. I think this is the space where you will find continuous challenges.
This is IT you're talking
yes.
about.
Say 10 to 11% kind of a top line growth guidance if majority of the companies are giving, and then if you give 16, 17 times of a multiple, I think either the earning has to or revenue has to catch up much higher to sustain that kind of evaluations, or there could be some...
No, but people point to the fact that, well, look at margins, look at profits. I mean, they are still very strong. So does that with 10, 11% kind of profit top line growth, dollar revenue growth?
I think, see, people are right now looking at IT and pharma, or what, if you see last 6 months, I think this is the pack which has actually outperformed also. And that's primarily because what was happening across the globe, and metals kind of a sell-off which we have seen, barring the last few weeks rally. So it was a kind of a hiding place according to me, and people have hided there for maybe 6 months or a year time. And if the earnings are not going to catch up, and if the way I am seeing the other side of the story of India is going to pick up, I think you will find some shift coming from this defensive, so far defensive sector to some of the aggressive sectors.
What about pharma specifically? You earlier mentioned about some issues there as well, right? India focused pharma. So yeah, what's your view?
So there, I think if you there are two issues right now. One is positive, and of course one is slightly negative. Is that on the positive side, if you see the kind of ANDA approvals which has come for the Indian big giants, I think it has improved. So if I see the 3-year chart, I think the space was coming down. The approvals were dramatically lower, and going forward, I am seeing some uptick there. That is the positive side. The second, of course, we have been stuck with that $15 billion kind of exports in the pharma for the last few years. And if you see our generics market share in the US market, I think there also it's close to around 13-14% kind of a range for 3-4 years. I think there's a good possibility that we can have some larger share from the Indian generic companies in the US market specifically. The third piece I think people are more worried about, and what has happened actually in the last 1 year, 1.5 years, is almost all the companies have seen kind of a 483 regulation checks or FDA checks. I think I would treat that as a positive sign, because here is your plant is kind of cleared, after the initial foundings, and you clear it. So it gives you a kind of a growth visibility for the next 3 to 5 years, once though your plants are getting approved. And obviously the companies will face some music if you're not compliant with the US FDA guidelines. So I think put together, if I see banning valuations, obviously I'm not going to go for a much higher valuations there, but I think the space looks reasonable because of the overall global opportunity size which is available to the Indian companies.
Yogesh, it's a pleasure talking to you and having you here in our studios. Hope to many more interactions from our studios here. Sure. Thanks indeed.
Thanks.